5 dividend ETFs that you could add to your portfolio to generate additional income. What's up everybody, my name is Tom from Control Your Wealth and welcome back to my channel. In this video I'm going to break down 5 of the top dividend ETFs for you to invest in 2023. Of course, you don't need to own all 5 of them because you'll see some of them hold similar assets and it all depends on what type of ETF you're looking for. Our first dividend-focused ETF is the iShares Core Dividend ETF, or DGRO. This ETF focuses on dividend growth stocks, which are companies with a record of paying regular and increasing dividends. It's a low-cost option with an expense ratio of just 0.08%. So for every $1,000 you invest, you only pay 80 cents each year. Now, let's take a closer look at what's under the hood of DGRO. Information technology and financials are the top sectors, with over 18% stake each, followed by healthcare, industrials, and consumer staples. The top 5 holdings are led by Exxon with a weight of 3.27% and Apple. The next in line are Microsoft, JP Morgan, and Johnson & Johnson, all with relative similar allocations. What's great about DGRO is its diversity, with 447 different stocks. Currently, DGRO's 30-day SEC dividend yield is 2.48% and a 12-month trailing yield of 2.34%. This implies the yield an investor would have received if they had held the fund over the last 12 months. The dividends are distributed quarterly, and with a 5-year dividend growth rate of nearly 11%, the dividend has increased for 8 consecutive years. The price of the ETF itself has risen around 145% since 2014, with an average annual return of 10.77%. All in all, DGRO is a great choice if you're looking to invest in dividend growth stocks. The second ETF on this list is SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. SPHD has an expense ratio of 0.30%, which is a bit higher than the previous ETF. This means that for every $1,000 you invest in this ETF, you will pay $3 in fees each year. When we look at the sectors, we can see that real estate with over 19% and utilities at almost 16% are the biggest ones. With 11 different sectors in total, this is a pretty diversified ETF, but it only holds 51 different stocks, which is significantly less than DGRO. The top 5 holdings of SPHD are Altria at 3.27%, AT&T at 3.07%, followed by Verizon, Kinder Morgan, and Simon. Again, pretty close in terms of weight. The top 10 stocks make up nearly 27% of this ETF. Now let's take a look at the returns. Since its inception in 2012, SPHD is up around 160%, with an average annual return of 9.6%. And when you look at the dividends, it pays it out monthly and currently has an SEC 30-day yield of 4.51%. And looking back at the last 12 months, it had an average distribution rate of 4%. As you can tell, that's quite a bit higher than DGRO. Both have their own qualities in terms of a lower expense ratio and more diversification versus a higher yield. So, that's the second ETF on this list, the Invesco S&P 500 High Dividend Low Volatility ETF. Before we get to the next ETF, do me a big favor and click that like button down below. It's huge for the growth of this channel and I greatly appreciate it. Our third dividend-focused ETF is the Schwab US Dividend ETF, or SCHD. This one has an expense ratio of just 0.06%, making it a very low-cost fund. So for every $1,000 you invest into this ETF, you're paying only 60 cents each year, which is the lowest we've seen so far. Now let's take a closer look at the sector breakdown for SCHD. As you can see, it's again a very broad ETF, with information technology making up over 21% and financials with over 20%, followed by consumer staples, healthcare, and industrials. When we look at the top 10 holdings, we can see they are very close together, so this composition might change throughout the years. But right now, as it stands, Broadcom is the top holding with almost 5%, followed by Verizon, Cisco, Merck, and Texas Instruments, all very close to each other. These top 10 holdings make up roughly 40% of the entire fund, with 103 different holdings. Now let's zoom in on the returns and dividends. Since its inception in 2011, the asset price has risen over 220%, with an average annual return of 12.4%. which is amazing given the fact that you're also receiving dividends on top of that. It pays the dividends on a quarterly basis, and over the last 5 years, the average dividend yield has been 2.9%, while currently sitting at over 3.5%. On top of that, the dividend has also increased each year for the past decade. So, overall, the Schwab US Dividend ETF is an excellent broad-range dividend ETF. You're getting a solid dividend yield with a strong growth and amazing returns. And you're diversifying across different sectors. The next ETF, the fourth on our list, is the Vanguard High Dividend Yield ETF, or VYM. As the name suggests, this one focuses on more higher yielding dividend stocks, which is true, but you also see that SPHD and SCHD actually have an even higher yield than this one. As it's standard with most Vanguard ETFs, this one also has a very low expense ratio of only 0.06%. Let's take a closer look at the sector breakdown. We can see that financials is the top sector with almost 21%, followed by healthcare with over 14%. So that's a pretty big gap between the number 1 and 2. Further, we can see consumer staples, energy and industrials in the top 5. When we look at the top 5 holdings, we can see they're again pretty close in terms of allocation, with ExxonMobil as the top holding at 3.3%, followed by Johnson & Johnson at almost 3%, and after that comes JP Morgan and Chevron and Procter & Gamble. Together, the top 10 holdings covered 23.5% of the total 441 holdings. Since its inception at the end of 2006, VYM has risen over 160%, with an average annual return of 10.31%, paying out dividends quarterly with currently a 30-day SEC yield of 3.01% and a 12-month trailing yield of 3.04%. Over the past 5 years, it's had a dividend growth rate of 6.25%, and a dividend has increased for 12 consecutive years. VYM is a great ETF with a low expense ratio and very decent returns. It's a great addition to any portfolio. The last ETF on our list is the iShares Core High Dividend ETF, or HDV. Just like VYM, this ETF focuses on stocks that pay a higher yield than average. It has a slightly higher expense ratio than VYM of 0.08%, but it's still relatively low. The sector breakdown shows that it's heavily weighted in energy and healthcare, with energy as the top sector with over 26%, followed by healthcare with 22%, together making up almost half of the entire ETF. The next sector in line is information technology, with almost 12%, which is much less than the first two sectors. In terms of the top 5 holdings, the leader is ExxonMobil with almost 10%, followed by Verizon and Chevron. The top 10 holdings make up over 53% of the entire ETF, and in comparison to VYM, this ETF has a lot less holdings, with only 75 in total. Looking at the returns, we can see that since its inception in 2011, the ETF has risen almost 125%, with an average annual return of 8.41%. It pays out dividend quarterly and currently has a yield of 4.4%, with a 12-month trading yield of 3.69%. Overall, HDV is an excellent ETF, especially if you're looking for diversification into energy and healthcare, which historically have been strong sectors during a recession. So, there you have it, 5 of my favorite dividend ETFs. We looked at some highly diversified ETFs with DGRO and VYM, both holding over 400 different stocks, and we also discussed a few dividend growth ETFs, which might be a little lower in yield, but have more growth potential in terms of share price and dividend growth. Let me know in the comments which of these ETFs fits your profile best, and thank you so much for watching. If you liked this video, you may also enjoy another one that I've linked here on a simple but effective ETF strategy recommended by Warren Buffett himself.